Hi, hello guys. Let's start a discussion on a very important topic, which is the infrastructure project appraisal, where we are going to discuss three key and very important pillars of the infrastructure credit appraisal, which is a technical, commercial, and the financial evaluation in detail in a perspective of the development financial institutions or the bank or this specifically in the NaBFID Senior Analyst role or the analyst role if you applying and aspirant for this role. This video will help you guys to understand the infrastructure project, NaBFID mandate and roles and how that three pillars technical, commercial and the financial are important for the infrastructure project appraisal, where we discuss on the objective and scope of technical evaluation, then the financial and the commercial evaluation objective and scope, and then we discuss on some sectors and their the risks and what that mitigate with that risks in the NaBFID or the development financial institutions. Then we are going to discuss on with the technical or the financial or the commercial risks is occurs, then what are the mitigation tools or technique has an analyst you need to use, and the specific appraisal things we discuss. And lastly, we are focusing on one of the and most important case study, guys, that will help you to understand how the credit how the infrastructure project appraisal will be part of important in the infrastructure sector, and how the technical and commercial and financial evaluation, that three key main pillars are impacting on that. Let's start discussion on this topic. Before moving to detailed discussion, guys, I would like to request you guys, if you are new to my channel, so please do like and subscribe my channel, so that will motivate me to create and more such videos, guys, and also help you to prepare for the government and the private sector base roles in the market risk domain or in the quant analyst domain or the IT related domain like a business analyst or the quality analyst kind of roles. So that's why I would request you guys, please do like and subscribe my channel. So let's move on the next slide, guys, where we are going to discuss on why appraisal matters for the NaBFID and the development financial institution, and why it is important in the NaBFID. So we know, guys, the infra projects, the duration of infra projects is a large capex. It take a 20 to 30-year life of that project to close and to return the principal and interest rate from the borrowers or from the sponsors. So it is irreversible high public impact. It impact huge on the public. So that's the infra projects. And NaBFID mandate has an analyst, has a senior analyst, or has an working professional in the development financial institutions. So you should be finance bankable, bankable and national infra projects. So that's finance bankable and the national infra project you should finance. Has an analyst role, you should ensure that the that project should be buildable, sellable, and the bankable. You should understand that three key things in that project should be buildable, that should be built, and that should be sellable, that should be no usable for the end user, and that should be aligned with the objective and purpose of that projects, and it should be a bankable. So the three key main pillars, if any fails, credit risks increase sharply. That three key main pillars will not be fail. If any fail, then the credit risks, then the as an lender, as a NaBFID, you need to think twice before lending to some infrastructure projects. So first one is a technical. In a technical way, we should ask the questions to that ourselves: can we build or and operate it? Can that project is feasible in a technical perspective? Can that with that technology which the sponsor are going to use, or the EPC contractor, engineering, procurement and construction contractor will use, and from that technology that project can build, and that will be the usable for the end user, that in the perspective of the cost and revenue. Then second one is a commercial is most important. Will anyone pay for it? it is more important. If you create and the infrastructure project like road or the solar or the wind energy, if the end user will pay much amount to use resource or that the project, so you should think is there how much the amount for that the end user will pay to use that services. So that's you need to think. And the financial, will debt be repaid? So you should if we land for the 10,000 or the 100,000 crore to infrastructure project, so we should think is the debt which we are giving that project is a repaid and it can be recover from that the project. So that's the financial perspective we need to think. So let's move on that three key pillar in detail and understand the objective and scope and the tools with NaBFID need to check in detail. So let's first discuss on the technical evaluation and objective and scope. So let's discuss first on the objective of technical evaluation. So confirm the project is technically sound, feasible and sustainable. So the objective of technical evaluation we should do, we confirm and we do the analysis and we from the agreement, concession agreement, EPC contract, operation and maintenance contract, we should identify is that project is a technically sound or feasible and sustainable, or the is that project will completed within a commercial operation date or the date of commencement of the commercial operation. So that will achievable, each milestone of that project is achievable. So we should think and that objective we should do in a technical evaluation with that technology. Then the key areas to appraise in that perspective, first one is a site and land, ROD, typography, legislation, CIMIC flow. So is we 100% land is acquired, is there any challenges related to site and related to land that we are going to feasible, is that land or is there a nearby available the raw materials which we need to build that the project. Suppose if we are creating the roll track, so we need the stones or the strong stones, so that in nearby the stones availability is there, so we take that thing. And then the technology, so proven versus the pilot technology we consider, TRA level, vendor credentials, is that technology, how much the cost, availability of that technology, feasibility of that technology, we should take that thing and the cost, and then conclude the final is that amount we can repay for that technology, and that from that technology can user satisfy and we can recover the amount from that technology in the all kind of projects like the road construction project, rail construction project, or the solar energy corporation of India, like the solar energy, wind energy, or the hydro energy project, or the water management kind of project. So in the executional plan, so we should check the EPC contract timeline, we should check the PERD, CPM, and the LD clauses that are in that the project. So the performance evaluation and review technique, critical path methods, we check how much that will required, what are the EPC contract, it is a fixed term or non-fixed term, what types of the EPC contract will have, and the timelines or the milestone, is that feasible technically, or the to achieve that milestone, or the durations that achieve milestone is sufficient or not sufficient, what are the remediation, what are the actions that need to be take if that is not the satisfy, and what are the force major that will look in the future. So we consider that thing. And then the inputs, so the inputs like a power, water, fuel linkage, and the logistics, that are the inputs we are required for to complete that infrastructure projects. So what are the costs for each input, what are the resources for each input, is that the availability, we check the availability of input, if that the inputs are not available on time, so what, how much the cost we need to pay for that, and how much that will impact it on the cost of the projects. Then the clearances, so EEC, PC, SRG, RM cost and input. So environmental clearances or the social clearances, we need EC for the environmental clearances. Forest clearances we require. because we are conducting the land, we are acquiring the land, it is from the government land or the no or the individual land, so we need to clearances from the environment or the forest department. And then the operation and maintenance plan, it is and the most important, guys. So while the how much the cost, life cost, spares, performance guarantee under the operation and maintenance, how much the cost are required for the operation and maintenance that projects, and how much we are generating in the form of the revenue. Then the red flag, land not 90% in possessions, is the first and the most important red flag in the technical evaluation side. If suppose we are going to land 1000 crore or 2000 crore, and that projects for the land will not acquire for the 90%, so there is a huge chance the fluctuation in the price of land acquiring, and we might be lose huge amount in the land acquisition. So then in that case the land acquisition of 90% is most important. Then the conditions of environmental clearances and upon the takes that we need to get considered in the technical evaluation of the infrastructure project appraisal. So let's move on the next slide, guys, where we are going to discuss on the technical evaluation tools and the NaBFID checks that must be checked by the senior analyst or the analyst. So analyst tools to check that thing. So first and the most important, independent engineer or the lender independent engineer report, which is the most important tool which we need to refer while write down the infrastructure project appraisal note. Then we self do the site visit checklist of that site visit to verify by ourselves. And then the techno economical viability, we check is that project is a technical and economical viable. And then we do the study comparison with benchmark, is that achievable with the different kinds of benchmark and the geotech and the traffic studies of the revenue. And then we look at the NaBFID specific alignment that the analyst must keep in mind while working on such projects. So alignment with the PM Gati Shakti, it is the most important part in the infrastructure side, which is a PM Gati Shakti, which are where the 27 ministries are come together and they are developing the infrastructure projects. They support each other to grow the infrastructure project. That's why the PM Gati Shakti is a most important national infrastructure projects or the national infrastructure pipeline. We should go read the national infrastructure pipeline in detail and the sectoral policies which are defined by the NaBFID or the regulator or the NaBFID in the perspective of the infrastructure development. Then the check for the cost benchmark. So each kind of the projects or each kind of sector in the infrastructure, like the data is one of the growing sector, or the road sector, or the solar or the energy sector, or the water management or the resource management sector, or the airport construction sector, or the port construction sector, or the rail or the road bridges, rail bridges construction sector. So these sector have different the benchmark that defined by the RBI. Okay, so that need to be considered, or for the solars or the highways, that need to be considered. Then the ensure the technical risks cover in the concession agreement. So we need to make sure that we need to ensure that the technical risks are covered in the concession agreement with 360-degree analysis. What are the pros and cons, 5W analysis, why, what, when, where, and how that will be happens. So and the short analysis part we should do in the technical evaluation in the concession agreement. So let's move on the next slide, guys, where we are going to discuss on technical evaluation and objective and the scope of the technical evaluation of that the we are going to discuss on the next slide, guys, where we are going to discuss on the commercial evaluation and its projects objective and the scope. So the objective of commercial evaluation is assess the market risks and enforceability of revenue streams. We identify what are the market risks in that projects and how we are going to assess that market risks, and what are the enforceability revenue, what are the factors that drive the revenue of that the commercial valuation projects. So as an senior analyst, what are the key areas to appraisal and that you need to consider for? So first one is a demand, because demand is the most important thing, guys, where we are do the traffic study, PLF, cargo volume, or the CAGR, uh, CAGR assumptions, the capital average growth revenue assumptions. So what are the traffics that needs to be the study? Why that traffic is improved day, year by year? Is that reduced, or is there the alternative things? What are the demand and supply for that projects? Is how the importance of that project? So that's we study in the demand. Then we consider the revenue models, different kinds of revenue model like toll, annuity, power purchase agreement, user charges, or viability gap funding, TOT, toll, operate and transfer kinds of model, build, operate and transfer model, hybrid annuity model, where the government institutions like the national highway, the NHA, National Highway Develop Authority of India, or the Solar Energy Corporation of India, they will finance for the 40% and remaining will with the sponsor and the lender finance for the HAM model, and which is the huge kind of model. And then the power purchase agreement, where they define once the construction is done, then the output is generated. So the off-taker, how much the price, what are the costs that off-taker will purchase the output from that the infrastructure projects, and that need to be do. And also we consider the viability gap funding. If the government is thinking that that project is a commercial, is a very good, technically very good, and the financial very good, but as a sponsor perspective, they think if that project cost is 80,000, so we can 80,000 crore, so we can invest in that projects. But the practically, or but the technologically, but the commercially, that project is 10,000 crore. So in such case, the government will grant the 2,000 crore. So in that case, the different lender or different sponsor will enter to take a benefit from viability gap funding. So that amount they don't need to pay the government. It is a grant. It is a grant that will provided by the government for the private players to create such kind of projects, and that is a commercial is viable for that projects to the government. So then the traffic, regulatory approval, escalation formulas, pass-throughs. So that's in the traffic we considers. Then the competitions, alternative routes, over capacity risks. So the competition, if we charge the very high, and if the end user will have the alternative routes, so they can use that alternative routes, and we will lose the leakage of the revenue. In that case will happen. So we need to analyze that all these things, and do the proper understanding of that thing, and highlighted such scenarios like a competition in that the projects. So the contract, the concession agreement, power purchase agreement, FSA risks, allocation, termination payment. So that all these things, EPC contract, operation and maintenance contract, we consider all these things while writing the or creating the infrastructure project appraisal. So then the counterparty credit rating like a discom, National Highway Authority of India, ULB, payment track record, we track there the payment track record, how that off taker is the good, and the history of that off taker we check and we analyze as and the senior analyst and the lending bank of the NaBFID. So that is the most important thing, guys. Then the red flag, no take or pay, or the merchant exposure is greater than 30% weeks escrow. So in that case, the merchant exposure will be greater than 30% if the less, the escrow is there. So let's move on the next slide, guys, where we are going to discuss on the commercial evaluation and the sector examples. Each sector we consider the road, power, port, urban, this sector, and they are the key commercial risks and the mitigation NaBFID looks for. So the road for the road is a traffic divergent, toll linkage, where we are going to use the hybrid annuity models, revenue models, so minimize the revenue guarantee, escrow for the tolls, escrow of the tolls, so that need to be tracked, trust retention account, debt service reserve account, that need to be tracked in the road projects. Then the power, if discom default, grid and curtailment will consider, the grid will consider, there will be the tri-party agreement, must run status, that need to be formed by the lender with the discoms or the off taker. Then the ports, hinterland competition, drought. So long-term cargo contains rail connectivity in the port project. There should be the rail connectivity, road connectivity. It should be manageable. It should be growable. It should be developable. That project. So that need to be considered. And the urban. So user charge the political risks. So user charge the political risks. State government guarantee, annuity models, HA model, hybrid annuity model. So that need to be considered in the uh, urban sector. So let's move on the next slide, guys, where we are going to discuss on the most important and the third pillar, which is the financial evaluation, and it's a core principle. So the objective of financial evaluation to ensure the serving the plus equity return under the trace. So we should ensure that debt servicing plus equity returns under the trace, because the equity returns are not there, so the sponsor will not be interested in that project. So if he is not get money or return, so why he will be the the interested in that project. So that is the most important, that equity returns under the trace. So the project cost and the structure. So hard cost plus the interest derivative IDC plus contingency 5 to 10% plus debt service reserve account, we should consider that thing. And that typically for the debt to equity ratio, it might be the 70 to 30 to 80 to 20, where the promoter upfront equity will involvement. So the key lender matrix where we are going to consider, so the matrix and the formula and the infra benchmark. So debt service coverage ratio, the formula of debt service coverage ratio is a cash flow available for debt service divided cash flow available for debt service divided by the debt service within a year, in that year, each particular year. So the debt service coverage ratio we calculated for the short term or the year by year of that projects. And the cash flow available for debt service is nothing but the revenue that generated from that project to all the costs like operation and maintenance cost or the statutory or the tax due. And then the that are the cash flows that available for the debt service. After the cash flow that available for the debt service, and that year what are the principal and the interest that need to be paid, that is a debt service. So in that case, in the infrastructure project, there is a minimum debt service is a 1.15 percent, and average will be the 1.25%. So in that case, we consider is a good projects that need to be. Then the loan life coverage ratio, it is and the most important, and it will be calculated for entire loan life. That the ratio, it is a long term ratio. And okay, so in that ratio we calculated the net present value of cash flow available for debt service for each year, every year, what are the net present value of cash flow available for the debt service. And we consider the date of entire date, or how much the in that entire the life of that project, how much the principal and interest we need to get paid for the date of operation services. So it should be the benchmark for the 1.3x, so it should be greater than the 1.3x, not below that. Then the project internal rate of return, so IRR of projects cash flow, so working capital plus 2%. So it should be a weighted average cost of capital plus 2%. What, how much, whatever amount of your weighted average cost of capital and more than that should be a 2%. Then the equity. So internal rate of return for the equity cash flows, it should be a 40 to 60% of the interest inter INR. And it is 5 to 7% greater than the market rate return. Why we are going to invest in such project if they are the given the return on the risk free rate? So we will be investing in the FD and do not take any risk. So that's why it should be more than 14 to 15% in the market risk. So let's move on the next slide, guys, where we are going to discuss on financial evaluation, cash flow, and the stress testing. So we consider a different stress scenario and do the test testing on each scenario, and we do is that the project is a financially feasible or not. So let's first understand the cash flow waterfall or the escrow waterfall, or how the cash flow will happen once that project is start generating the revenue. So the revenue will be first go to the operation and maintenance. All the revenue will go for the operation and maintenance. Then the statutory dues or the tax that need to be paid, that point is not covered here, but we go for the statutory dues, and then that amount will be paid to the lenders like NaBFID or the IFCL, so debt and services. Or then the remaining amount will go for the debt service retention account. So debt service retention account is the account which is created by the lender for if in case there is an uncertain event is happen, or in that particular period the sponsor are not able to pay the principal and interest rate on a due date. So in that case the lender will create the special account where the 6 months or the 1 year or the quarter of the principal and the interest are stored in the form of FDs. So that's account we calculated as a debt service reserve account. If the remaining amount will pay to the debt service reserve account or the major maintenance reserve account, it is one of the also account. So MMRA, major maintenance account, will get paid, and then the equity holders will get paid. Might be they retain, they make a retention of that payment so future progress of project, or they paid the remaining amount to the equity holder in the form of dividend. So let's do the sensitivity that must do as an the senior analyst in the development financial institution. So first one is the revenue will decrease the 10%, or the operation and maintenance cost due to some external factor or the cascading effect will increase the 10%, or the cost of commercial operation delay for the 6 to 12 months. So it is an the huge impact if the commercial operation date or the date of commencement of the commercial operation will increase for the 6 to 12 months, and the interest rate will increase the 100 basis point. So that need to we do the sensitivity analysis. Then the break even analysis at what the PLF and traffic is a debt service coverage ratio is equal to 1x, and the security structure mortgage plus hypothecation assignment and plus the escrow and trust retention account. So let's move on the next slide, guys, where we are going to discuss on how the three evaluation interlink. So that three evaluation, technical, financial, and commercial, are interlinked to each other, and how they're the relationship with each other. So first we are going to discuss on technical, how the technical will interact with the financial. So the 6 months delay increase the IDC, and debt service coverage ratio breaches the 1.x. So if 6 months delay, the delay in the increase the IDS, so that's how that is impacted on the financial breaches. Then the commercial, how that commercial will impacted on the financial. So 20% traffic shortfall, if suppose the traffic shortfall is a 20% or the 30%, so that will be impacted on the cash flow available for the debt service need to be debt, and that will be impacted or reduce the debt service amount, and but automatically the debt service coverage ratio will be the reduce, and there might be chance it will be comes to the 1. So how the commercial will impacted on the financial, and the technical how the technical will impacted on the commercial. Obviously guys, if technically we impacted, so then the commercial operation debt will get impacted and automatically the financial will get impacted. So the poor design increase the operation and maintenance cost. So if poor design and poor the construction phase or do the poor construction, so that will increase the operation and maintenance cost. We need to continuously operate and maintain that road or the ports, and then the traffic hike rejects and the revenue will get traced from that project. So then the analyst decision, so the technical not okay, then reject and modify that project. If that project is technically not okay, so then you can reject the project or modify the projects and make sure that project is a technically good or fit for the technically. Then the commercial weak, ask for the grant stronger off taker. If that project is a commercial weak, so we need to ask for the grant or the viability gap funding in that project, or ask for the sponsor to provide more equity in that project. Then the financial tight, reduce the leverage, extend the tenure, and credit enforcement will be there. So let's move on the next slide, guys, where we are going to discuss on the NaBFID specialist focus. So where we are going to focus in the NaBFID perspective, and in the NaBFID perspective, we are going to analyze. So long tenure feed, development impact, credit enhancement, or the key conditions and appraisal note flow. So the long tenure fit, guys, you need to mug up or you need to understand infrastructure project financing is a long in the duration. It is on the long tenure financing which we are going to do. So match the loans to life with 2 to 3 years tail. Guys, the tail period, which is the project life period and the loan project life period minus the life of that project. So it should be more than 2 to 3 years. So we, if it is a less than 2 years, so that project is a not good project and we might be not financing such kind of project. So the tail period is should be a more than 2 to 3 years. Then the development impact, so once how much the impact of that project on the social, economical, social and governance. We need to clearances from the socials or the governance or the economical things, how that project is good. And the job creation, is that project will create the different kinds of jobs, or that will help to grow the Indian economy and the national infrastructure pipeline alignment, or is that project is satisfy or the aligned with the national infrastructure project alignment. So then the credit enhancement, blended financing is the most important term, guys, where we are going to enter you. You should understand the blended financing in detail and you should be mug up the concepts or blending financing. And the partial credit guarantee take out financing, so that need to be considered in the glide. So let's discuss on some key points of the blended financing as an the analyst perspective. So in the blending financing, there is a some portion of equity. The blended finance is a strategic combination of public and the philanthropic funds with private capital to finance a sustainable development in emerging market. It lower the risks and commercial investor, allowing projects such as the infrastructure or climate initiative that are initially deemed too risky and unprofitable to produce the helping bridge development and funding gap. So that's why we consider the blending finance in the project. So the key components of blending finance is the concessional capital, commercial capital, de-riskings, and the main purpose of the blended finance is a mobilizing private capital, supporting the sustainable development growth, market creation. We create an market. So the common sector, for the example, like common investor one, global fund, IFC blended finance. And the key challenges in the blended finance is complexity, transparency, and geographical focus. So that need to be considered, guys. So let's discuss on the appraisal note flow, how that flow of that appraisal notes you need to understand while writing the appraisal notes. So in the credit appraisal notes or the appraisal notes, first we write the executive summary, where the reader can understand what entire projects, what are the objectives, and what the purpose of that projects that need to be summarized in the first 10 to 15 lines, that is the executive summary. Then the sponsor, where we add the total sponsor details, the technical and all these things we add related to the sponsor, contract type, concession agreement. So all these things consider in the sponsor. And the technical evaluation, write the technical evaluation, which I am going to explain in this video. Then the commercial, then the financial. Then we consider risks and its mitigation techniques. What are the kinds of risks and how we are going to mitigate that techniques, what are the tools and techniques once the risks will appear we use, and what kind of the risks, like construction risks, revenue risks, or the credit risks, operation risks, market risks. Okay, so land acquisition risk. So these kind of different risks, how to mitigate, and finally the recommendations that need to be given for the higher management and the decision making committee. So that's a thing we'll get there. So let's discuss on the class exercise. So let's discuss on one of the exercise. So that will help you to be a part and to be a think on to preparation of the infrastructure project appraisal. So the if suppose the 6 lane greenfield have a project. So greenfield is the new and the project will start from the scratch. So there are the two types of projects. One is a greenfield project and another one is a brownfield project. So brownfield project is already constructed project. We know how much the revenue generating from that project. We know how much the traffic will create at that project. So that project is already created. Land acquisition will happen. The construction will happen. So such kind of project is a brownfield project. And the greenfield project, it is a totally new project. That projects where the nothing will start. It is the start from the project will start from the scratch. So the 6 learn greenfield projects, and it is the 120-kilometer projects and hybrid annuity model, which is the most preferable model. In there is a different kinds of the model, but hybrid annuity model is more preferable. And the 48 crore cost for that project. So the 48 crore is the cost of that project. So the split into three groups of that the case study. So technical group, commercial group, and the financial group, and the lastly we finally deliverables. One slide recommendation for the NaBFID CCs. So the technical group lists three key risks in the DPR mitigation. So we consider in the three risks which we already discussed in this video. Then the commercial group evaluation, the National Highway Authority, annuity terms, any concessions that need to be considered or that need to be addressed in these projects. For the financial group, if the traffic ramp up, delay 2 years, impact on the debt service reserve, or how if there is a technical impact and the commercial impact, how that is impacted on the financial of that project. So that need to be considered while to writing or to creating the infrastructure project appraisal notes. And then the deliverables, one side recommendation to NaBFID. So lastly we create the one side recommendation of that project, whether we are going with that project or not. If we are going with that project, so what are the reasons, what are the things that allow us to go with that projects, where we consider the debt service coverage ratio, loan life coverage ratio, or the commercial factor or the operational factor, like a traffic risks, revenue risks, or how much the revenue that generated that projects. Is there alternative, is there any competitive way? So that need to be considered in that case for the such kind of the things. So here is the end of this interesting seminar, guys. So before wind up this video, I would like to request you guys, if you are new to my channel and if you are want to grow in your career with the higher roles or the top role, so please do like and subscribe my channel. And also if you have any questions, if you have any open points related to the new notification, related to the market risks or the quant risks or the infrastructure project side, so I will happy to help you guys. And I am here to give you opportunity to work in the big four or the topmost government organization. Once again, guys, thank you so much guys for attending this interesting seminar. Please do like and subscribe my channel. Once again, thank you so much, guys. Thanks, guys.